Welcome to Training Capabilities, short tutorial on how recreation leave is calculated. My name is John Allen. I'm a Director of Training Capability and I'm often asked this question. Cost centre managers are often confused of how annual leave expense affects their budget and therefore their cost centre's financial performance. Now it's important to stress up front that recreation leave is expense to your cost centre when your employee earns the annual leave, not when they take the leave. This first PowerPoint slide uses a simple example to explain how leave is calculated. Let's say your employee earns $120,000. For simplicity's sake, I'll divide this annual income by 12, so the monthly salary is $10,000 per month. Because we are using accrual accounting, leave expense is charged to your cost centre when leave is earned, not taken. The employee is entitled to 4 weeks recreation leave, which equates to $10,000 plus another 17.5% leave loading, which equals $1,750. The total amount owing to the employee for annual leave is $11,750. The total salary and leave expense for the employee for the year is $121,750. In the example used here, your employee is at work for the first 11 months of the financial year. The expense to your cost centre is $10,000 per month. On the 12th month, they take recreation leave, so there's no expense to your cost centre as this is paid from the annual leave liability account. The employee's annual leave liability account has $979 added each month, accumulated during the year as the employee earns recreation leave. Note, the employee still earns $979 annual leave even when they're on leave. So where does this money come from to pay for your employee in the 12th month? This next slide will provide another simple explanation. Each fortnight, the annual leave earned while the employee is working, the green section, is calculated and deposited into an annual leave liability bank account. This money is quarantined until the employee takes their recreation leave. In this ideal example, the employee takes a leave in the last 2 fortnights. There is no salary expense charged to your cost centre as this money is refunded from the annual leave liability bank account. The only charge to your cost centre is a $979 accrual that your employee earns while they're on leave for the 4 weeks. Now to the big question. How does the amount of leave my employee take each year affect my budget? We're going to work through 3 scenarios. The first one is a neutral scenario to your budget. Your employee earns 4 weeks annual leave and takes 4 weeks leave. The next scenario is a negative situation where your employee again earns 4 weeks annual leave but only takes 2 weeks leave. And a third is actually a positive scenario for your budget. This is where your employee earns 4 weeks annual leave but actually takes 7 weeks leave. Now note, in all the examples here, the employee is not backfilled. In other words, nobody will be paid to do their job while they're on leave. So the first scenario, your employee earns 4 weeks and takes 4 weeks leave. Now the budget is formulated to assume that the employee will be at work 48 weeks, which they are, then earn 4 weeks of annual leave, totaling 52 weeks. As the employee worked 48 weeks and took leave of 4 weeks, this has a neutral impact on your budget for the employee. Now in the next scenario, your employee earns 4 weeks annual leave but only takes 2 weeks leave. This situation is unfavourable to your budget. This scenario is also formulated with a budget allowing for the employee to be at work for 48 weeks. However, as they've worked 50 weeks, you paid an extra 2 weeks salary for the staff member, which will lead to a budget overrun of 2 weeks. The budget allowed for 4 weeks annual leave accrual, which is also reflected in your actual results. The net effect of this is that you have budgeted for a combination of 52 weeks, which is 48 weeks of salary, and 4 weeks of annual leave. However, your employee's only chosen to take 2 weeks leave. The net effect of this is an unfavourable result for your budget, as you paid the employee 50 weeks of salary plus another 4 weeks of annual leave expense. The net effect is that you paid out 54 weeks of combined salary and annual leave expense, leading to a 2-week salary overrun, which would equate to approximately $4,600 overspend for that employee. The final scenario is where your employee earns 4 weeks annual leave but takes 7 weeks leave. This final scenario is favourable to your budget as the employee is taking a lot of leave, 7 weeks. I'm often asked, how does that actually work? As with the previous scenario, you budgeted 48 weeks of salary. However, your employees actually only work this year for 45 weeks. The same scenario applies to formulating the budget for 4 weeks annual leave, which is reflected in the actual results, as the employee earned 4 weeks. The net effect of this scenario is that while you've been given a budget of 52 weeks salary and annual leave expense for that employee, your cost centre has only been charged for 49 weeks, which is a 3-week saving to your budget, or approximately $7,000 saving that you can use elsewhere in your cost centre. The message here is it's good for your budget to take more leave than they earn, as long as the position isn't backfilled, and a staff that don't take leave will cause you to have a budget overrun. Are you looking for more clever ways to save budget? Training Capability partners with cost centre managers and hospital executives around Australia to find innovative saving solutions such as this and increasing revenue in our hospitals to improve service delivery to patients. If you're interested in learning more or would like John or Elizabeth to deliver tailored to your hospital cost centre manager training, please contact them at john@trainingcapability.com or elizabeth@trainingcapability.com. Thank you.